Assalamu alaikum students. Welcome to another episode of Account in Telikilaas. My name is Ali Rashid. I'm from Hirilindu School. Today our topic is bad debts or irrecoverable debts. Today you will be learning what bad debts are and what are the different implications bad debts have on business and the accounting system. Now students, let's have a look at the learning intentions for today's lesson. One of the objectives of today's lesson is for you to understand what bad debts or irrecoverable debts are, and also to understand the different reasons why bad debts may occur in the business, and also learn what journal entries record bad debts and what journal entries are required to transfer bad debts to the income statement at the end of the financial year. So by the end of today's lesson, I hope that you will be able to successfully understand what bad debts are and use the different journal entries in the accounting records to record bad debts and transfer bad debts to the income statement. I also hope that you learn different ways to reduce the risk of bad debts in the businesses. On to the definition of bad debts, students. What is a bad debt or what are irrecoverable debts? A bad debt is any debt or any amount owed by a credit customer which we will not be able to collect from the credit customer. In other words, all the amounts of trade receivables that we are sure we are not going to get back are called irrecoverable debts. For example, let's say we sell goods worth 500 to a credit customer, and then due to a personal reason or due to a business related reason, we are 100% sure that this customer is not gonna pay the amount to us, or that this customer is 100% unable to pay this amount to the business. Then we decide that this is an irrecoverable debt or a bad debt. Now students, what are the reasons why bad debts occur in the business? One of the reasons is the customer might have disappeared, he might have gone out of business or become bankrupt. That's another reason. Or due to any reason, if the customer is unable to pay the amount, we consider that as a bad debt. Now there are steps that we'll have to follow before we actually decide that a debt is indeed bad or irrecoverable. For example, when the payment is delayed by a customer, we'll call them and we might inform them first, maybe a phone call. Then we will write to them informing, and then if still payment is pending, we might send a warning letter. Then we might also charge interest for the overdue period. If all of these steps are followed and still we fail to collect the debt from the customer, then we decide that it is a bad debt. And then we immediately close the trade receivables account, the customer's account, by making a credit entry on the customer's account. Now students, you know from grade 8 also you have learned that whatever decreases a customer's amount will appear on the customer's account credit side. Agree? So the bad debt figure also we will put on the credit side of the customer's account and we will close his account. And then we will open a bad debt account and keep all the bad debts on the debit side of the account until the end of the year. And when the year end comes, when we want to prepare the income statement, we will close the bad debt account by making a credit entry on the bad debt account to transfer the total amount of bad debts for the current year to the income statement. Why are we transferring bad debt to the income statement, students? Because bad debt is an expense and it has to be shown in the income statement under the expenses section. Now this is how you will be making the entries for bad debts. First, when a bad debt occur in the business, we open the bad debt account by giving a debit to bad debt account, and then we credit the trade receivables account or the customer's account in order to close that account. Now why are we giving a debit to bad debt account, students? Because bad debt is an expense and we debit the expense account as the expense increases. So when a bad debt occurs, we give a debit to the bad debt account. Now at the end of the year, students, we want to close the bad debt account and make the transfer to the income statement. How do we make the transfer? We debit the income statement and then we credit the bad debt account. Bad debt account was originally debited when it was created. Now in order to close the bad debt account and make the transfer, we give a credit to the bad debt account. And this is how you will do it in the general journal when you are asked to when you are asked to pass journal entries to record bad debts. First you will debit the bad debt account and then you will credit the trade receivables account and then you will debit the income statement and then credit the bad debt account. Now students, we go into a question. In this question, Gary is a manufacturer of kitchen equipment. His financial year is ending at 30th September. And then on 1st August 2019, he had a customer, a trade receivable, Edward. Edward declared bankruptcy and he owed an amount of 326 to the business. And then Gary decided to write this amount off as a bad debt or an irrecoverable debt. Now the question is asking us to prepare journal entries to record the writing off of Edward's balance. A narrative is required. It is clearly stated in the question. So then we go on to the journal entries to record the cancellation of Edward's amount. We give a journal entry, we debit the bad debt account 326 because bad debt is an expense, we will have to debit that account. And then as I mentioned before, whatever decreases a customer's amount will come on his credit side. So on the credit side of Edward's account, we record 326. And then at the end of the year, we want to transfer this amount to the income statement. We write income statement debit and then we close the bad debt account by giving a credit of 326 to the bad debt account. So what is happening here is, students, when the bad debt is created, we debit the bad debt account because it's an expense. And then we close the customer's account by giving a credit equal to the amount he has owed to the business. And then at the end of the year, we close the bad debt account by transferring the total amount of bad debt to the income statement account. Now students, because we have past journal entries, we go and check the ledger accounts, how the ledger accounts will be affected. Now we know that Edward is a credit customer, a trade receivable. So his account will have a debit balance of 326 as it was. Now, because he has gone bankrupt, we want to close his account. How do we close Edward's account? By giving a bad debt entry of 326 on the credit side. So now his account doesn't have a balance CD, which means we are not expecting him to pay. And on the same date, we open the bad debt account and give the entry in Edward's name 326, and we will keep the bad debt account as it is until the end of the financial year. When we prepare income statement, we will make the entry on the credit side of bad debts account, income statement 326, so that the bad debt account is closed. So students, what are the three things that are happening in relation to bad debts? The first thing is creation of bad debt. When a bad debt occurs, we debit the bad debt account and we credit the customer's account. And then at the end of the year, we close the bad debt account by making a transfer to the income statement by writing the same amount or the total amount of bad debt that is already recorded in the bad debt account. We give an amount equal to the equal to whatever is on the debit side in the name of income statement, so that the total of bad debt for the year is transferred to the income statement as an expense. Now students, let's have a look at a slightly different question here. In this question, Sophia is the owner of the business and Wade Designs is a credit customer who owed 5,100 to Sophia but has gone bankrupt. And then the question is asking us to prepare journal entries, which means we are required to prepare a general journal and make entries for whatever happened on the date 28th February 2016. Now let's look at what happened on this date. First, a check of 1,800 was received from Wade Designs. So even if they went bankrupt, they are able to pay a part of the amount, a part of the 5,100, which is 1,800 in check. So Sophia is getting 1,800. So the entry made will be bank debit 1,800 because Sophia is getting the money through bank, and then this receipt of amount will decrease the amount owed by Wade Designs. So Wade Designs will have a credit entry 1,800. As I mentioned before, students, whatever decreases the trade receivables amount will come on the credit side of the trade receivables account. So the payment of 1,800 will decrease the amount owed by Wade Designs. So Wade Designs has a credit 1,800 here. So then what is the other thing that happened? The balance of the amount, that means 5,100 was the total. From that 1,800 was received, and the remaining balance amount, which is 3,300. How do we get 3,300? 5,100 minus the amount received 1,800. We have 3,300. That balance was decided as a bad debt or irrecoverable. So what happens, students, when we decide that a debt is irrecoverable? What are the entries? Debit, bad debt account, credit, customer account. So the of the 5,100, 1,800 was received, and then the remaining amount 3,300 was decided as irrecoverable. That means it's a bad debt. So we give a debit to bad debt account, and then we give a credit to Wade Designs. So here two entries are made in the Wade Designs account. What are the two entries, students? 1,800 on the credit side, again 3,300 on the credit side. So the total of 1,800 and 3,300 is 5,100, which closes the amount, which closes the account of Wade Designs in Sophia's book. Now students, let's have a look at the three accounts that were affected due to this transaction: the Wade Designs account, and the bank account, and the bad debt account. First of all, we know that Wade Designs had a balance of 5,100 on the debit side, so it's here. Now on the 28th February, a payment was received. Also, the remaining amount was declared as a bad debt. Agree? So Wade Designs account must be closed. So what happened first was we received an amount of bank, so we credit Wade Designs account, and then we debit bank account. This is what happened first on the same day. And then still, if you look at the Wade Designs account, still an amount is remaining. 5,100 minus 1,800 will still be remaining if we did not decide it as a bad debt, but then we decided it. So bad debt amount of 3,300 comes on the credit side. That will effectively close the account of Wade Designs, and on the same date we will make an entry on the debit side of the bad debt account Wade Designs 3,300. Now students, let's have a look at how the transfer occurs. I'm just showing you an extract of the income statement here, only the expenses section, where we just take the bad debt amount from the bad debts account and write in the income statement under the expenses. Now students, what happens if Sophia had more customers who failed to pay? Then the bad debt account, on the debit side you will see more customers names. Agree? Just like Wade Designs, maybe you will have Mr. X 500, Mr. Y 600, like that. Whoever fails to pay, whoever is regarded as a bad debt, will come on the debit side of bad debt account. So if Sophia had more trade receivables who failed to pay, then the bad debt account will have a bigger balance than 3,300. And at the end of the year, the total of bad debt will again come in the income statement. If she had more bad debt, then the amount will be more than 3,300. That is how the transfer occurs from the bad debt account to the income statement. Now, students, let's have a look at different ways to reduce the risk of bad debts. First of all, you will have to understand that bad debt is a risk for the business because this is a amount of money that we expect from customers, goods that we have sold to our credit customers for which we expect them to pay. Agree? So if they fail to pay, it is clearly a loss to the business. So there is a risk of bad debt occurring. So as businessmen, as traders who try to maximize their profit, they will always be looking for ways to reduce any risk. So because bad debt is a loss, we want to know what are the ways that we can avoid or limit the amount of bad debts that occur in the business. So one way of reducing bad debt is reduce credit sales. This makes a lot of sense, right, students? You sell less on credit, you have less risk of customers failing to pay. So we try to sell more for cash so that the amounts are received directly in cash at the point of sale. And then another way of reducing the risk of bad debt is fix a credit limit for each customer. So whenever we have a credit customer, we tell them that this is the credit limit, let's say 1,000 or 2,000. We will not be selling goods for you worth more than this credit limit. So when we set a credit limit, customers will not owe more than that limit. So the risk of bad debts happening will be reduced. And another good method is to offer cash discounts to encourage prompt payment. What does this mean, students? We offer cash discounts for those customers who pay on time. So customers will be encouraged to pay on time. So the more they pay on time, the more cash we receive and the less the amount of trade receivables owing. So when we have less owed by credit customers, we'll have obviously less amount of bad debts. And then charge interest on overdue accounts. This is, as I mentioned before, if customers are constantly delaying the payment of amounts, we will charge interest. We will inform them, okay, you owe 500, you are not paying 500 on time, so we are going to charge interest so that your amount will keep increasing. So customers will not want the amount to increase because if that happens, they will have to pay more. So in order to pay less, in order not to create this interest, customers are likely to pay on time. And students, let's close the lesson with the lesson summary. What did we learn today? You learned that bad debt is any amount which will not be paid by our credit customers due to any reason. Could be bankruptcy, could be personal reasons, could be financial crisis. For whatever reason, if any of our trade receivables fails to pay and we are 100% sure that we are not going to get that money from the customer, we regard that as irrecoverable debt or bad debt. You also learned that bad debt is considered as an expense and it has to be transferred to the income statement at the end of the year. You also learned the journal entries that would record bad debts in the books. First, when bad debts are created, we debit the bad debt account and then we credit the customer's account. And then at the end of the year, to transfer the bad debt amount to the income statement, we will give a debit entry to the income statement and we will credit the bad debt account. And as the last part of the lesson, you learned various ways to reduce the risk of bad debts, such as selling less on credit, setting a credit limit for customers, and then offering cash discounts to customers so that they'll pay on time, and also charging interest on overdue amounts for customers who delay the payment constantly. We charge an interest so that they will pay on time. That will be all for today, students. Hope you enjoyed the lesson. Hope you learned what bad debts are and different journal entries that record bad debts, as well as techniques that could be used by businesses to reduce the risk of bad debts. Uh, Inshallah, we'll meet next week with another lesson. Meanwhile, you stay at home, stay safe, be good to your parents, keep learning, keep exploring, keep asking your doubts from your teachers. I hope you have a great day today. Thank you very much, students. Wassalamu alaikum wa rahmatullahi wa barakatuh.